As November 2025 draws to a close, the American stock market finds itself at a pivotal moment, recovering from its most significant pullback since April, yet still shrouded in a thick fog of uncertainty. The mood on Wall Street is tense, with investors and analysts alike weighing every data point, every headline, and every whisper of economic change. The market's recent volatility has left many wondering whether the worst is truly behind us, or if more turbulence lies ahead. The S&P 500, a broad measure of the market's health, is up an impressive 16% year-to-date, putting it within striking distance of its all-time high. This rally has been fueled by a mix of resilient corporate earnings, hopes for a soft economic landing, and the belief that the Federal Reserve may soon ease its monetary policy stance. Meanwhile, the Nasdaq, home to many of the world's leading technology companies, has lagged slightly behind. This underperformance has sparked debate about whether the tech sector's remarkable run is losing steam, or if it's simply pausing before another surge. Investors are questioning whether the innovation that once drove tech stocks higher can continue to deliver in a more challenging economic environment. Across trading floors and boardrooms, investors are searching for the next catalyst. Will positive economic data or a dovish signal from the Fed push markets to new heights? Or is a reversal looming, with profit-taking and renewed fears of recession waiting in the wings? The stakes feel higher than ever as each trading day brings new twists and turns. Historically, December has been a strong month for stocks, with the S&P 500 averaging a 1.4% gain since 1950. This so-called Santa Claus rally is often fueled by holiday optimism, year-end portfolio adjustments, and a general sense of hope for the future. But this year, past trends offer only limited comfort. The market's recent swings have left many investors on edge, questioning whether the usual seasonal boost will materialize or if caution will prevail. The stability of today's market is fragile, hinging on more than just seasonal optimism or historical patterns. Geopolitical tensions, shifting consumer sentiment, and the unpredictable path of inflation all threaten to disrupt the delicate balance. Investors are no longer satisfied with bold promises or flashy innovation alone. They now demand clear, credible paths to profitability from the companies they back. The era of growth at any cost is giving way to a new focus on sustainable earnings and disciplined management. The conversation has shifted from hype and speculation to hard questions about earnings, cash flow, and the overall health of the economy. Analysts are scrutinizing every quarterly report, looking for signs of strength or weakness that could shape the market's next move. In the coming weeks, the market's resilience will be put to the test as it digests a flood of new information. Economic data releases, corporate earnings, and policy updates. Each headline has the potential to sway sentiment and trigger sharp moves in either direction. The stage is set for a fascinating and potentially volatile final month of trading in 2025. As the countdown to year-end begins, every decision feels more consequential. Will optimism and the hope for a strong finish win out, or will caution and risk aversion take hold as investors brace for the unknown? One thing is certain: investors are watching every tick, every chart, and every headline, ready to react at a moment's notice. The outcome of this high-stakes month will not only determine how 2025 ends, but will also shape the narrative and set the tone for the markets as we head into 2026.
Artificial intelligence has defined 2025's investment landscape, fueling a tech rally and sky-high expectations. The excitement around AI has been palpable, with investors pouring billions into companies promising to revolutionize everything from healthcare to finance. Headlines have been dominated by stories of breakthrough algorithms and record-breaking funding rounds, creating a sense that we're on the cusp of a new technological era.
But as the year ends, excitement is giving way to skepticism. Investors want to know, when will AI investments pay off? The initial euphoria is now tempered by hard questions about sustainability and real-world impact. Many are starting to wonder if the rapid rise in valuations is justified, or if we're witnessing the early signs of a bubble.
The costs are massive. Building advanced AI systems and data centers isn't cheap. Companies are investing heavily in infrastructure, hiring top talent, and acquiring vast amounts of data. These expenses are necessary to stay competitive, but they also put immense pressure on balance sheets. For many firms, the path to profitability is long and uncertain.
Now, investors are weighing long-term promise against short-term financial strain. The question is no longer just about who has the most advanced technology, but who can turn that technology into sustainable profits. Some are rebalancing their portfolios, shifting away from speculative bets toward companies with clearer paths to revenue.
Some valuations seem driven more by optimism than earnings. There's a growing realization that not every AI startup will become the next industry giant. The market is starting to distinguish between hype and genuine value, rewarding companies that can demonstrate real progress and punishing those that overpromise.
The era of buying any stock with AI in its business plan is fading. Investors are becoming more selective, scrutinizing business models and demanding evidence of traction. Companies that fail to deliver tangible results are seeing their valuations drop, while those with proven products and paying customers are standing out.
Investors are separating true innovators from trend followers. The focus is shifting to those who can execute, scale, and deliver measurable outcomes. Partnerships, customer wins, and recurring revenue streams are becoming the new benchmarks for success in the AI sector.
The focus is shifting to practical implementation and monetization. It's no longer enough to have a cutting-edge algorithm. Companies must show how their technology solves real problems and generates revenue. The winners will be those who can bridge the gap between innovation and impact.
The central challenge for AI in 2026 will be proving profitability, not just potential. As scrutiny intensifies, companies will need to back up their visions with solid financials. Those that can't demonstrate a clear path to profit may struggle to survive in an increasingly competitive landscape.
The market is demanding results, not just promises. Investors are watching quarterly reports closely, looking for evidence of growth and efficiency. The days of unchecked optimism are over. Accountability is now the name of the game.
Only the strongest business models will survive this new scrutiny. Companies that can adapt, innovate, and deliver consistent returns will emerge as leaders, while others may fade into obscurity. The AI sector is entering a phase where discipline and execution matter more than ever.
The AI sector's next chapter will be defined by real returns. As the dust settles, only those who can turn potential into profit will shape the future of this transformative industry.
Alphabet and Nvidia are the poster children of the AI boom, but scrutiny is intensifying. Alphabet's $4 trillion valuation rides on the promise of its new AI model, Gemini 3, but expectations are sky high.
Nvidia's dominance in AI chips is being challenged as companies like Google develop their own hardware.
Meta's interest in Google's chips signals real competition for Nvidia.
Even the biggest players face pressure to deliver results and defend their turf.
In this fast-evolving field, no one is immune to disruption.
The AI race is as much about financial muscle as it is about technology. Companies are spending tens of billions on R&D and infrastructure, straining even the largest balance sheets. Soaring valuations raise concerns. Have prices run ahead of reality?
Tech giants are issuing debt to fund AI ambitions, but higher debt means higher risk.
Any misstep in capital allocation or delays in returns could trigger sharp corrections. Investors are now scrutinizing cash flow and debt levels as closely as product roadmaps. The stakes are higher than ever. Financial discipline will be as crucial as innovation.
The Federal Reserve's next move on interest rates is dominating market sentiment.
After years of rate hikes, dovish signals have investors betting on cuts at the December meeting.
The probability of a rate cut has surged, fueling the recent rally.
Lower rates would boost the economy and corporate profits, justifying higher stock prices.
Optimism is spreading beyond tech, lifting the whole market.
Every Fed comment and economic data point is under the microscope.
The market's hopes and risks are tied to the Fed's next move.
December's decision could set the tone for 2026.
A recent 43-day government shutdown has left investors flying blind, with key economic data delayed or missing.
The lack of reliable reports on jobs, inflation, and growth has created a data fog.
The Federal Reserve faces tough choices, forced to act with incomplete information at its December meeting.
Will the Fed cut rates without a clear picture, or wait and risk disappointing markets?
A full economic snapshot may not emerge until January 2026. Investors are piecing together clues from alternative sources, heightening volatility. Every new data point now carries extra weight.
The holiday shopping season is the first big test. Early sales data will reveal consumer strength.
Key economic reports on manufacturing, services, and consumer sentiment are next.
Salesforce's earnings will signal business tech spending trends.
Retail giants like Kroger and Dollar Tree will show how households are coping.
Management commentary will be as telling as the numbers.
These updates will shape expectations for 2026. The market is watching every signal.
As rate cut hopes rise, investors are rotating into sectors left behind by the tech rally.
Small cap stocks, hit hard by high borrowing costs, are rebounding on the prospect of cheaper financing.
Small cap outperformance signals a healthier, broader market.
Real estate and utilities could also benefit from lower rates.
A rally led by diverse sectors is more durable than one driven by tech alone.
If this rotation continues, it's a vote of confidence in a soft economic landing. The market's breadth will be a key indicator in the weeks ahead.
Investors are watching risk sentiment closely, with Bitcoin's sharp drop signaling caution. The sudden plunge in the world's largest cryptocurrency has sent shockwaves through the financial community, prompting many to reassess their appetite for risk. For some, it's a wake-up call, a reminder that even the most popular digital assets can be vulnerable to swift and dramatic changes in sentiment.
Bitcoin's fall from $125,000 to below $90,000 suggests speculative froth is fading. This dramatic correction has left investors questioning whether the era of easy gains in crypto is coming to an end. The rapid sell-off has also triggered margin calls and forced liquidations, amplifying the volatility and leaving many traders on edge.
Crypto's pullback may reflect broader risk aversion even as stocks rally. While equities have managed to hold their ground, the divergence between traditional markets and digital assets is raising eyebrows. Some analysts believe this could be an early warning sign that risk appetite is waning across the board, not just in crypto.
The next few weeks hinge on three forces: AI profitability, the Fed's rate decision, and fresh economic data. Each of these factors has the potential to shift market momentum dramatically. Investors are bracing for a period of heightened uncertainty, where every headline could move markets in unexpected ways.
If AI spending delivers real profits, optimism could surge. Companies betting big on artificial intelligence are under pressure to prove that their investments will pay off. Strong earnings from tech giants could reignite enthusiasm and drive a new wave of buying, but disappointment could just as easily trigger another round of selling.
The December Fed meeting is pivotal. Will they cut rates or hold back? The central bank's decision will set the tone for global markets, influencing everything from borrowing costs to currency values. Investors are parsing every word from Fed officials, searching for clues about the future path of monetary policy.
Incoming data on holiday sales and manufacturing will reveal the economy's true strength. Robust consumer spending and resilient production numbers could signal that growth is on solid footing, while any signs of weakness might stoke fears of a slowdown.
The market is walking a tightrope between hope and fear. Every uptick brings a sigh of relief, but every dip revives anxieties about what lies ahead. Investors are forced to balance optimism about innovation and growth with concerns about policy shifts and economic headwinds.
Every day will test investor confidence as 2025 ends and 2026 approaches. The countdown to the new year is more than just a change of calendar. It's a test of resilience, strategy, and adaptability in a rapidly evolving market landscape. The stakes have never been higher. As the world watches, every decision, every data point, and every market move will shape the financial narrative for the months to come.